The shop opens at dawn, but there is already a line outside. Not because people are eager to buy, because they are afraid there won't be anything left. Inside, the shelves are full. Bread, flour, sugar, all there. But no one is spending. Every customer stares at the price board, then at their wallet, then leaves. This is London, 1931. Gold is winning, and the economy is dying. For decades, politicians told the public the gold standard was the ultimate guarantee of stability. A system that prevented reckless spending. A system that kept money honest. A system that stopped governments from destroying currencies. What they never explained was the cost, because the gold standard didn't just limit governments. It strangled entire economies at the exact moment they needed to breathe. This isn't a story about coins and vaults. It's a story about rigidity in a fragile world, and why tying a living economy to a metal nearly collapsed global civilization. To understand why the gold standard failed, you first need to understand why it seemed perfect. Under the gold standard, every unit of currency was directly convertible into a fixed amount of gold. If you had a pound, a dollar, or a franc, it wasn't just paper. It was a claim on metal. This created trust across borders. Exchange rates were fixed. Inflation was low. Capital flowed easily. In theory, governments couldn't cheat. They couldn't print endlessly. They couldn't inflate away debt. Money was supposed to be boring, and for a while, it worked. During the late 19th century, global trade exploded. Industrial output surged. Financial markets became interconnected. The gold standard became synonymous with progress. But beneath the surface, a fatal flaw was forming. Gold does not grow with the economy. As populations expanded and industrial output increased, the supply of gold did not scale proportionally. That meant money became increasingly scarce relative to economic activity. Scarcity sounds responsible. In reality, it was lethal. When money supply can't expand, prices must fall. That's deflation. And deflation doesn't just lower prices. It rewires human behavior. Why spend today if everything will be cheaper tomorrow? Why invest if debts become harder to repay over time? Under deflation, saving becomes rational, spending becomes irrational, and economies freeze. This problem remained hidden during boom periods, but when the global economy was shocked, the gold standard turned from anchor into weapon. That shock arrived in 1929. The stock market crash was violent, but crashes alone don't cause depressions. What followed did. As economies contracted, banks failed, businesses closed, unemployment soared. Under a flexible monetary system, central banks would respond by expanding the money supply, lower interest rates, inject liquidity, stop the bleeding. But under the gold standard, they couldn't. Every pound printed required gold backing. Every dollar injected risk training. Reserves. So instead of easing, central banks tightened. Interest rates were raised to defend gold reserves. Credit was restricted. Money was pulled out of circulation. At the worst possible moment, this turned recession into catastrophe. The United States lost nearly 30% of its GDP between 1929 and 1933. Industrial production collapsed by almost half. Unemployment reached 25%, and policymakers did exactly what the gold standard demanded. They did nothing. Because under gold, economic suffering was not a policy failure. It was considered discipline. Countries that tried to escape suffered even worse, at least at first. When Britain abandoned the gold standard in 1931, it was seen as humiliation. The pound fell sharply. Financial elites panicked, but something unexpected happened. The economy recovered faster than gold-bound countries. Exports became competitive. Interest rates fell. Employment stabilized. Meanwhile, countries that clung to gold, like France and the United States, sank deeper. By 1935, the pattern was undeniable. The earlier a country left gold, the faster it recovered. Gold wasn't protecting economies. It was suffocating them. The reason is simple, but brutal. The gold standard assumes economic equilibrium, but crises are chaotic. When panic hits, people hoard gold, capital flees, reserves drain. To defend gold, governments must raise rates and cut spending, exactly when the economy needs the opposite. This creates a feedback loop. Economic contraction reduces tax revenue. Governments cut spending. Unemployment rises. Demand collapses further. And because money cannot expand, there is no escape valve. Gold turns every downturn into a deflationary spiral. This wasn't theoretical. It was mechanical. And it didn't just break economies. It broke societies. Germany, still scarred by hyperinflation in the 1920s, clung desperately to gold discipline. The result was mass unemployment and political radicalization. Economic collapse didn't create extremism, but it fertilized it. History didn't just rhyme here. It screamed. By the time the United States abandoned the gold standard in 1933, the damage was already historic. Franklin Roosevelt didn't frame it as ideology, he framed it as survival. Gold convertibility was suspended, the dollar was devalued, money supply expanded, and almost immediately, the economy stabilized, not because gold was evil, but because rigidity in a crisis is fatal. The gold standard failed because it treated money as a moral system rather than a functional one. It assumed restraint was always virtuous. It assumed markets self-correct quickly. It assumed human behavior remains rational under stress. None of that is true. Money is not just a store of value. It is a coordination system. When that system cannot adapt, everything breaks. This lesson didn't disappear with gold. It resurfaced in the Eurozone crisis. Countries like Greece effectively operated under a modern gold standard, unable to print currency, unable to devalue, unable to respond. Austerity replaced flexibility. Recession deepened. Youth unemployment exceeded 50%. Different century. Same mechanics. What the gold standard teaches. US is not that discipline is bad. It's that timing matters. Constraint during booms can prevent excess. Constraint during collapse destroys recovery. Economies need elasticity. Gold offered certainty. But certainty without flexibility is fragility. Today, people romanticize gold as protection against inflation, as a symbol of stability. But history shows something colder. Gold doesn't prevent collapse. It decides how collapse unfolds. Under gold, crises are longer, deeper, and more socially destructive. The bakery in London eventually reopened to customers, but only after Britain let go of gold. Prices stabilized, spending returned, confidence rebuilt, not because gold was abandoned forever, but because survival required adaptation. The lesson isn't that money should be limitless, it's that money must be alive. Rigid systems break under stress. Flexible systems bend and survive. Gold couldn't bend, and the world paid the price.